Thanks for opening up the toolkit. I'm Justin Fortier. Today, my guest is Cortec Group co-president Dave Schnadig, who joined to discuss what he's learned from running an operationally intensive private equity firm. At Cortec, he nurtured the development of companies like Chauvet, Groundworks, and YETI, where they turned a $67 million investment into $3.3 billion during Dave's 7-year term as chairman. Cortec is now investing out of their 7th fund, which is $2.1 billion in total. In this episode, we talk about what makes a good company to buy, developing a firm to actually handle the hundreds of opportunities they review per year, and also support management teams to grow after they've already invested. The Cortec Group is a little bit different than what you might think of with private equity, so it's really interesting to hear their perspective. And also, since I'm interested in starting a business or buying into one, I asked him about what are the things that founders or operators do that typically hampers the business, and he gave me the 2 best ways to improve a business's value. So listen for those towards the end. I really enjoyed this episode. I'm incredibly grateful for Dave for taking his time. He's clearly got a ton of experience both in private market investing and as the chairman of a publicly traded company. So I hope you enjoy. If you like investing, if you're interested in private equity or running a company, this episode's for you. Thank you. Now straight into the interview.
So we were actually just talking about people and hiring specific experts. And listening to one of the podcasts you had done before, I noticed Cortec started as a group of operators, but then it transitioned to, they really did need some of the financial skill set that you brought from investment banking. And now the firm is mostly run by people with a financial background, but you're still doing the original intended approach where you're really helping with the operations of all your portfolio companies. How did you get to that point where you're acquiring those different strategic skill sets? How'd you get the talent selection and get up to date on all these variety of industries you're actually in?
That's a great and multifaceted question.
Sorry.
No, it's great. And I'll take you back because this has actually been highly strategic from answering the question, how do we actually deliver value to our companies? And when I first met the original Cortec folks who are not here anymore, some of them literally not here anymore, they were much older. They were clearly business people, but they were extremely limited. They were virtually all engineers, and they focused on highly engineered components rather than on an end product. So something that might go into a nuclear submarine or a piece of aircraft or even a complex piece of machinery that was non-governmental. Those folks were very narrow and very deep. And as a result, their limitations showed themselves in a number of ways, including the fact they'd never even been out of the United States for business. So they'd never gone to China. They'd been to Europe, but the world was shifting. I grew up in a family furniture manufacturing business in Chicago that was global. That was the largest family-owned furniture manufacturer in the world at the time. My grandfather started it. My dad was a lawyer, wasn't involved at all. And so, but I was the eldest grandkid and I was fascinated by business. And so my grandfather took me on trips to Taiwan first and then mainland China as China became more of a manufacturing powerhouse. And I really got to witness firsthand the growing quality capability set, as well as incredibly low cost that the Chinese manufacturing world brought to bear. And furniture was one of the first industries actually that got meaningfully disintermediated by China. It was incredibly instructive. I got to see as part of the family business a number of things beyond the global nature of business, which my Cortec folks didn't really understand. I also got to see how businesses evolve and become by cost and quality combinations. And I also really got to learn firsthand about different functional areas of business, even as a kid, whether it was sales or marketing or product development or operations, inventory and things like that. But I didn't really understand P&L, balance sheet, et cetera. And I went to a management consulting firm out of college also. It was a general strategy firm based in Chicago and was global at the time. Had a really good couple of year experience, went to business school at Kellogg and at Northwestern. I really became painfully aware through a number of my peers who were in either accounting or banking, how little I knew about financial statements. And I felt like having the knowledge base of business and finance was critical. So I worked in banking for 4 years, but I was never a bank. And I will tell you, Jess, it was agony. I think that we used to do timesheets, physical timesheets every week. And when I left, I looked back and I had 3 or 4 days before my official end date. And I quit, to be clear, to go to a completely different job, which was fascinating. And I totaled up my hours and I averaged 92 hours a week over almost 4 years. That is no way to live. But I got 8 years of learning in 4 years. And so I was just blend. And when I eventually came to Cortec, they were a bunch of business guys in a very narrow vertical. And I didn't think that model was scalable. And it turned out that I was right. And it's a very long answer, but that the baseline here is important for you to understand. And so what wasn't going to work was a bunch of older guys who were pretty set in their ways, who were knowledgeable based on history of things to do in businesses, but were lacking a lot of other contextual and analytical capabilities because they were so narrow. What my partner, Jeff, when we hired him a couple of years later, and I decided in 99, as we put really a framework in place to grow the business and to evolve it, was that we want to keep operating capability. And Jeff came from operations. He led 2 divisions of $1 billion public company. Okay, so he was a businessman, and he and I co-lead the firm. So our leadership team is really almost 50-50 across those who come out of industry and those who come out of transaction land, as we call it, just to set the record straight. But in terms of our vision for where we wanted to go, we wanted to hire younger folks who run businesses similar size to those we'd be buying, so 100 to 500. And we wanted to have knowledge sets that were in areas where we were going to be investing. So we hired one of those people out of consumer products, another person out of e-commerce, which covered both D2C, but also B2B in terms of distribution and other businesses. And then another one in healthcare to supplement Jeff. And so we hired our main areas and have hired, continued to hire. And those folks were typically 36 to 45, so that they're not fully set in their ways. They still want to learn. They didn't want to be CEO of a Fortune 500 company. They wanted to mentor, assist, build lower middle market companies into something meaningful and sustainable. And then there's actually a slide I should have sent you explaining all of this, but we try to explain to our investors how our model's different. We take the folks that come out of business and have been doing that for 25 years, right? So they're fully formed CEOs or general managers or presidents. We take those folks and we expose them meaningfully to the transaction side. They're not doing the modeling, but they see the outputs and they have to figure out, is $12 million of annual revenue growth a smart thing to model, or should we be modeling less or more, and why? And what kind of capital structure we should be considering, 15,000 other things that go into a model. And they're part of that process. And they also learn the process of buying and selling companies, which is nothing running on them. And so we build this blend basically where the business person is learning transaction stuff as they go up the ladder. The transaction folks who come in as 25-year-olds with 2-3 years of investment banking experience and nothing else, as part of our interviewing process, we spend a lot of time trying to understand if they're really interested in business or if they're just number crunchers. And some people, really love being number crunchers. There's nothing wrong with that. Or they're analytical without having an EQ. And we try to find those folks who are relatively well-balanced, hardworking, but want to learn always the business context for the analytical exercise. And then have this goal of becoming a blend of business and transaction knowledge over time. If they really don't want that, then we're not going to hire them. And we show them this pyramid that this is how you evolve. And to be a managing partner at our firm, you really have to be a business thinker first and a numbers thinker second. And that's what we've tried to build. So that is the model that we have. We continue to evolve it back to the black belt piece. So we hired a guy last year who ran global supply chain for the largest division of Danaher. Danaher Corporation is literally, and you may have heard of it in your consulting.
Big acquirer, right? They acquire all the time and integrate.
They are widely regarded as the number one place to learn global best practices across almost all functional areas in manufacturing and supply chain. They were originally founded as basically a public company that was doing private equity-like deals. They build themselves up by acquisition. But what they got really good at was actually driving organic growth in the core of what they owned. So we hired a guy from Danaher who ran global supply chain for a $3.5 billion division. He actually was head of all operations, not just global supply chain. And he was 45 when we hired him, and literally total rock star. On the manufacturing side, he was a lean black belt. On the supply chain side, he had run purchasing through a variety of different organizations, which means buying other people's stuff. He had spent years and years traveling the globe and going to factories that were third parties to vet and institute and vet qualities. He knows every aspect of operations. So do I. But I don't do it for a living. I never did it for a living, and I never got paid to do it. I've learned it from the outside in. He knows it from the inside out. He also happens to have a ridiculously great personality. And so he can ingratiate himself to our management teams and have them view him as a tool to add value to their businesses, which is exactly what he does. So that was a huge hire. And what we've continued to do, and hopefully you're hearing this, is that running Cortec and running a business, it's a continuum of looking forward all the time and trying to implement those things that make sense in your business as quickly as you can, so you can capitalize on these trends as they continue to occur. It was like a decade ago when I put e-commerce investing, which wasn't even called e-commerce back then, in front of our team here. And we talked about some of the mega trends around first distribution, actually. And it wasn't D2C, it was all B2B, about creating systems whereby customers could order via a portal and how that portal would operate. And it was all off the internet at the end of the day, and communications via email. And it all seems like this was 100 years ago, but what's shocking, just it was 10. And so we started investing in e-com businesses on the B2B side. And then we took some of that knowledge and capability, and actually it was a cornerstone of my strategy for YETI, which was to build a D2C business because they didn't have any. And we had a branded product that we thought if we talked directly to our consumers, we could actually build a relationship that didn't have that intermediary between us, which is the retailer. And so now YETI does more of its revenue on its own website and through Amazon than it does through third-party retailers. And we're growing third-party retail at 30% a year. So it just tells you how fast e-com's is growing. And anyway, my point is we're continually looking. We want to continually supplement this firm with folks from real world business experience, train them up on the deals, but add value as a team of people who came up from transaction land and business land. And that's how we staff them. Every business that we invest in actually has 5 Cortec professionals. And it's always run by a managing partner. And while I'm the co-president, I'm also a managing partner. And we lead the deals that we do. We don't go play golf. I try to play golf, but I actually work. And so that's the model.
Yeah. And that makes a lot of sense how you're adding people. And I heard on a previous interview that you guys look at a lot of deals, but actually can rule out quite a bit. When you're talking about training people up on the transaction experience, I think you said that it's dangerous to just go where you think you're already competent, as opposed to looking to buy a really great business. And when I look at some of the businesses that are on your website, like Chauvet and YETI and Groundworks, these all seem
totally
to be
different,
like,
right?
Yeah, all totally different, but do seem to have a very strong premium. I wasn't able to tell just by my brief looking that you're going for many businesses that are like, we're a commodity where we're trying to just have the best manufacturing people in there who are going to churn it out quickly. Am I perceiving that strategy right? And tell me a little bit about what boxes have to check when you are looking at a deal for it to be right for you guys.
A lot of boxes. You are right in the way you think about it. So to rewind, first and foremost, our overarching strategy is to partner with entrepreneurs and family to be the first control institutional capital in. And that's for our platform investments. The vast majority of add-ons we acquire for those platforms, we are the first institutional investor. So if you step down from that overarching strategy, and every once in a while we buy from private equity too, I will tell you, and sometimes investors crack up at this, but it's actually the truth. There are some private equity firms that actually do add value to the businesses that they buy. Some, I would say that it's the reverse Pareto rule. So 20% out of the 80. That leaves 80% of private equity who really just spends assets, don't know what they're doing. And they just look at numbers on paper because that's how they've been trained. They're just deal guys and guys and gals, by the way, men and women. We love those kinds of opportunities because we can see a business that looks a lot like what was a family or entrepreneur-led business and no value was added during the ownership. Shocking, but that's the preponderance of private equity. So we look for those as well. But about on the flip side, about 80% of what we buy, I think it's 82 or 83, we're the first institutional money in. So we start with that as our overarching. We're then looking for a lot of what you were just getting to, which is these are products or services that are differentiated and sustainably so. Take that as some next level down. And then you look at why and how are these products or services differentiated. Sometimes it can be patent protection. Sometimes it can be geographic strength or dominance. Tends to be the case in services more than products, and many other reasons. We have a 3.5-page checklist of what makes a great investment. 0 of the investments that we've made in my 26 years here have checked all the boxes. But the key is twofold. One, checking as many of the good stuff boxes as you can, and not checking the bad stuff boxes. So we're really careful about things like customer concentration, where, a change in relationship, offering 10, 15% lower prices, something unexpected that you don't even know can fundamentally change your revenue structure if you've got 25, 30% of your revenue with one customer. That's a big issue for us. Product concentration, the same. Do you sell an awful lot of one SKU that could either be made better by somebody else or just run out of steam because it reaches the end of its life cycle? So there are a bunch of things we just don't do. And commodity products is one of them. Actually, retail forever was on our list. We never felt the ROI of owning retail other than part of an omni-channel strategy over the last couple of years. Retail has never been a good place to invest. From our perspective, we turned out to be right there. Technology, we do not do software. We understand software quite a bit because I think I'm on my 11th ERP implementation right now. We understand software. We use all sorts of engineers and coders in a number of our different businesses, but that's as part of the business. Data science is becoming a huge deal in e-com right now. And we're building data science teams that are often made up of folks who either have very extensive mathematical training or training as software engineers, because they tend to be high IQ and very comfortable in mathematics, which matters an awful lot when you do coding and data science work. So we're comfortable with it, but we don't buy companies that do that for a living. There are other private equity firms that focus on it. So what we ended up becoming was a highly focused generalist, with our strategy at the highest couple levels being exactly as I laid out for you, with our businesses having a number of common characteristics and avoiding a number of things.
Interesting. I'm thinking about if somebody's starting a business in venture capital, which I get a lot of exposure to in my day job now. The venture capitalists are always looking for people who are just like looking for a world-changing vision. But I know a lot of people or my peers that might be interested in starting a company that eventually will probably be sold if they don't have any family to take that over. You mentioned that product concentration was one area that could significantly hurt the value of your business if you're trying to sell it. Are there some areas that you feel like are, I want to say low-hanging fruit, but I'm not sure if that's the right word, that a lot of these founder-led businesses typically don't have by the time you get there? That maybe if somebody's out starting a business, they should really think about, get this right early, because it could really significantly impact the trajectory of what you're building.
Yes, and they're the two hardest things to get right early because they're really expensive. And VC actually doesn't reward this. And we look at businesses that have been owned by VC. I do a bunch of VC stuff on the side because of the YETI investment. It's a longer story. Two things that people don't get right enough trying to build companies, but that are really hard to, as I started to say, are team and IT infrastructure. And it's for the reasons I said. When you're 25 years old or 22 years old, and you're primarily an idea trying to find a home, you don't have a lot of excess capital to build a proper team. And you actually don't even know how to evaluate talent. With time and experience and a lot of interviewing, we basically build teams from the director level or VP level on up. And I'll interview 100 people a year. And so will my partners. A year. I've been doing this for 20 something years. You meet lots and lots of people. We've honed interview guides. We have third-party personality tests that we use to supplement our interviews, and a bunch of other stuff that we've implemented as we've gotten smarter and better and more experienced. To build that team properly is costly. And when you're the entrepreneur and maybe you're bootstrapping without any VC, you're actually focused on cash flow because you got to keep the business going. This would be very hard. Same thing's true in IT. Any business that ships directly to consumer needs to work with Shopify Shopify is the best sort of low-end small company software to implement to manage your warehouse through to the shipment. And lots of people still don't do that. They sort of try to muscle through. Most people end up working on QuickBooks because that's where you start managing a business because it's less expensive, but that's not a leverageable package. So you have to get off of that as fast as possible. And without a Shopify, without a real ERP, you lose business information. So you end up managing business information with Excel as opposed to business information tools. And as a result, when you are the CEO of a 6-person business that's growing reasonably well, what you can't do is extract the data that you need to make smarter decisions. And the problem is that when you're that CEO, you're literally a fireman or firewoman. You're walking around with a fire extinguisher and you're just fighting those fires. And how can you think for a moment from a business analytical perspective when you don't have the data and you don't have the data, you don't have the time to tear through Excel? By the time you get some of that stuff, it's all way outdated anyway because you don't have business information systems. Being able to manage a bigger business becomes something that you can only aspire to, but you didn't put the building blocks in place to get there. It's the two most common issues that we see, and they're the two toughest to fix for the reasons I mentioned. There are plenty of other seeing businesses.
As a young person, especially in the management consulting business I was in, that was evidently apparent to me as the young person, because I'm usually the person trying to wrangle data. And I was like, how are these, in this case,
how are they running? How are they running the business?
We've got a $400 million revenue operation that seemingly has no insight into like 50% of their process. And that was mind blowing to me. And I was like, this seems like something they should fix, but there were always other fires, and we were usually coming in when the situation was bad. So there's even bigger problems to deal with. So we never got there. But my thought was always like, what could happen if you actually were able to organize business information in a way that like people could collaborate and speak from the same set of facts? That seemed really exciting to me, but I honestly wasn't sure if that was just a luxury, and I didn't have the context, but that was something that I thought was like, I try to get recording even in something basic and be willing to make that investment early on. Because one of my goals with this podcast is I plan on starting my own business in the next year or so. And that was something that seems like a good use of time for me, as long as I'm patient and willing to work around that. But that's reassuring
also
to hear.
Get partners who will feed that vision as opposed to starve it. Because you are right. Look, I'll tell you, one of our companies right now, which is growing very rapidly. It's very complex. It's 5 divisions that were acquired over time. And the base business, we bought this business from another private equity firm that was in the 80% category of zero value add, but we knew the core 100% D2C in specialty automotive parts. So for enthusiasts who like to fix their cars, and it could be just oil changes, but it tends to be more sophisticated than that. And we make as well as buy and resell a variety of very interesting stuff. So it makes good money. It doesn't have the infrastructure to leverage the combined enterprises. And there really there's some commonality across all the different business units. And from a process and a customer experience perspective, it's all the same. But they don't have a fundamental ERP from which to operate. So we're implementing that. They don't have a common warehouse distribution system to work from. So we're implementing a WMS, warehouse management software system. And then it doesn't have the same order to delivery logistics experience, which is what's called an order management system, different software than the WMS. And so we're implementing that. And we're implementing this across these 5, now soon to be 6 businesses. It's a massive undertaking to do that when you've got a $250 million business in multiple locations. And had they just done it right from the beginning, they could have actually managed it across the businesses as they bought. The prior PE owner didn't put a penny into systems, just milked it. And we knew we were going to have a major investment, and we're not afraid of it. So the great news is we've been growing the business at 25% a year for the year and a half we've owned it. We've got great performance under our belt. We can now take on this massive project that's going to, it's going to be a diversion. It's going to distract people from their day job. You can't just do this, and think as a hobby, it's all going to get done. cross-functionally, you have to have buy-in throughout the organization to ensure that an ERP implementation is successful. It's just not the IT department. And I've seen and been part of very unsuccessful ERP implementations early on, and we've improved steadily in how the checklist of what does and doesn't work gets implemented in each process. So this is going to be a bear, but it will be successful. And I've got a great team. First thing I did was hire a new CTO who's highly experienced in doing this, or CIO, Chief Information Officer, whatever you call them. And he had experience working with this particular software that we're implementing, which is something I've worked with 3 times before successfully, and the shortcomings and suit of the software. So anyway, it's agony ex post facto. If you've got it in early and you've got that ability to grow with that software, you're just saving yourselves a whole bunch of trouble and getting all the data that you and I were talking about that helps you make better business decisions real time.
Interesting. And do you work with third parties? You mentioned hiring a CTO. I listened to this podcast called the Private Equity Fundcast, which is Parker Gale, a small tech PE shop out of Chicago that's put out, I don't know, 100 episodes or so. And it's interesting because sometimes they'll bring on partners they use for everything from search to like code-based migration to
ERP implementation.
NetSuite implementation, things
exactly.
like that.
NetSuite's who we use a lot. Yep.
So is that something where you guys have a knowledge of what needs to get done, but you've built relationships with firms that specialize with that in order to get that get that done?
Well, first of all, 100%, we have the knowledge generally. 100%, third parties are always used. So when NetSuite will have called a partner VAR, a value-added reseller. So that won't be a Cortec relationship. NetSuite or any of the mid-market packages, Microsoft Dynamics, they have designated VARs that have done hundreds of implementations, and they're geographically dispersed. So in Chicago, you'll have a different VAR for a NetSuite implementation than we'll have in Cleveland for our company. But yes, we won't use those folks. On the flip side, we work with 2 different firms in almost every key, what I'll call supplemental due diligence function. So when we buy a company, we'll work with third-party marketing consultants to validate the competitive dynamics and market growth opportunities of the industry. And there are 3 or 4 folks we use there. We use 2 different accounting firms to do quality of earnings work, so we validate the numbers. We work with actually a firm based in Chicago called West Monroe to do our IT diligence, but we also use KPMG because they've hired a whole bunch of IT folks. So they'll go in and take us through what is typically the technology caused by either entrepreneurs or PE funds for not having put appropriate dollars into software systems. So we'll use those consultant type folks to help us out. But from an implementation perspective, Justin, we'll use specific designated third parties from our software. For example, actually for another business, we just bought a very large piece of machinery for the factory. That machine manufacturer works with a factory layout consultant to optimize efficiency and actually uses lean principles to ensure that efficiency is optimized and waste is limited. And so again, another expert who will be partner of an implementation. So if you split the 2 apart, for diligence and assessment, we use groups that are direct relationships with Cortec. For project-based implementation work, it'll be much more the vendor who will specify the partner, and then we'll vet the partner via reference checking through the portfolio company. Not at the Cortec level, but we'll make sure they're doing the right stuff that we would do anyway.
I'm going to switch a little bit. You talked about in the interview you did with the Trinity alum, I forget his name, the
Paul Sola.
Yes.
New York Times writer. Yep.
Scaling companies, a lot of times the founders you buy have hired lots of utility players versus players who are really good at something. Right. For somebody who's aspiring to be at the level you're at, which is a PE firm or like a business owner / president executive, is it possible to come up through both routes? And is that both paths? So if somebody says, I want to run a business by the time I'm 35 or 40, can you go either route? Or tell me a bit about.
I think it's a really, really good question. And here's what I think. I'm not sure I'm right about some things, but This I'm not sure, but I think I'm right. To your specific question about if you have the objective of running a business, I can tell you how you'll be the most well-trained leader. And it's how large businesses used to cross-train executives. So GE used to have a really interesting corporate training program that I thought was extremely value add. You spend 1.5 to 2 years in every functional area of the business. You want to be the most valuable leader. And by the way, leaders also have to be able to lead. They have to have charisma. They have to be articulate. They have to be incredibly patient. There are a number of personal characteristics. They have to be incredibly driven. They have to act like an owner when they aren't always an owner. I mean, there are tons of characteristics that must exist to make someone a successful leader, or should exist. There's some people who are remarkably unusual, like Elon Musk, who just rises based on pure intellect and hard work and a little bit of luck. Never hurts anybody. But back to the question, I would say work in sales, work in marketing, work in the different aspects of operations, work in HR, understand the challenges of hiring and firing people, the importance of culling poor performers. The bottom 10% rule is really important. You have to remove people who are not delivering. You have to give them opportunities to improve, put them on performance plans, give them tools. But if they do not improve sufficiently, you have to move on from them, because poor performers drag businesses down just as much as great performers bring it up. You need to spend time in IT. You literally need to work in every function of finance. Understand what's done. Understand how payables work and receivables, and ask questions and go through data and learn these functions, such that by the time you've done all that, it's 10 years later. And an athlete who's been trained in all the positions. So you're a utility player who's good because you understand every position. There are very few players in baseball today who can actually play almost every position. Chris Bryant's one of them. And Chris Bryant's value, and I'm a Cubs fan now that he's with the Giants, it's a bit of a tragedy to me. But Chris Bryant's greatest value is not all the home runs he hit and the fact he hit for average for much of his career so far, because he's still pretty young. It's that you literally can put him anywhere in the field, not catcher, not pitcher, but any other position he can play, and has played probably everything but shortstop, which is pretty unusual in this day and age when everybody's a position player. And so when you look at an organization of position players, they're all strong in what they do. When you're a little company, you don't have that luxury. Maybe you can hire a head of marketing if you're a digital e-com related business. Maybe you can hire a head of marketing who's got that deep skill set today. Maybe you can hire a really good young controller who could be your CFO. That's great. Maybe you get a salesperson if you've got product that's sold through the wholesale channel. Tough. All the rest of it, no way. You guys are all just going to be running around doing as much as you can at each functional area. I will tell you though, also, if you start a business at a young age, by definition, you learn how all the functions work, but you're in a trial by fire kind of way.
Yeah, sounds exciting. That's probably the path I'm going to pick, but for the pain,
yeah, it's exciting.
I'm ready to be surprised by the pain.
Yeah, it'll be painful. No, look, you'll just be tired. It's exhausting because you just don't, if you got a great idea and it gets traction, by definition, you just don't have enough team to keep up. That's the issue.
On the deal sourcing side for Cortec, when I interned at a private equity firm, they were sent a lot of deal memos, but the partner there, or not deal memos, but confidential information
memorandum
from investment banks.
Right.
And when I was interned at an investment bank, I helped prep some of those. But the private equity firm said, yeah, we get a lot of these. We look at everyone that comes through, but almost none of the deals we actually go through come from this route, but we might get some, and it's already prepared, and it helps us understand what businesses are out on the market. Is that a similar experience that you have, or how do you find deals?
In an average year, we look at about 550 platform opportunities, and we look at anywhere from 50 to 200 add-on opportunities. The platforms are businesses that average about 25 million in EBITDA. The add-ons can be anywhere from 1 to 15 EBITDA. For the add-ons, we're a strategic buyer. So those very often won't come through an investment bank. It may well come from an outreach from us direct to the business. And because we can say we're speaking on behalf of company X, Groundworks, for example, owners will take our call because we are the dominant, fastest growing player in the basement waterproofing and foundation repair industry. When it's Cortec, they get calls all the time from private equity. They don't take those calls. For a long time, it's that investment bankers represent the majority of companies that are for sale and that might well have an owner entrepreneur who wants to reinvest, because our model is not just to buy from the owner entrepreneur first, it's to have them reinvest materially alongside of us. If they just want to sell, they're going to look for the highest price. If they want to sell and reinvest materially, they know that second bite of the apple is going to be very valuable, particularly because of our track record, which I don't mean to sound arrogant at all, but our track record is extremely good over 26 years. It's very best in private equity globally. And if you reinvest, you should care. Who makes money? And I have a big hunk of your money, Mr. or Miss Entrepreneur. You may as well make a bunch of it on the way at the back end, second end. From our perspective, we work almost exclusively. We still get deals in directly and over the transfer, but almost exclusively with investment bankers. They account for 550 deals on average in a platform world. And this year, because of the emergence of COVID and likely tax law change, we're looking at almost 2x our normal volume. You might even see 1,000 opportunities this year, which is crazy. We're in total triage mode. But we do buy businesses sold by investment bankers. And think about it. If you own a company that's worth 300, 400, 500 million bucks, are you going to just wait for a phone call and hope to sell the right guy? No. You should pay somebody to extract value from the market and help you interview in a likely group of 5 to 10 buyers. And so we never worry about competing with other private equity firms. If they want to pay a stupid price, we won't pay it. And if the management team owner doesn't love our brand of private equity, deep partnership, every functional area, we're meeting every month in person. We talk anywhere from every day to once a week, depending on what's going on. It's them calling us. We don't call them unless there's a huge problem that we're working on together. And I've always said that the value add of a relationship or the pendulum of where it stands can always be measured by who calls who. You call somebody if you need something. And so if we're calling them, then we're a pain in the ass and not very helpful. If they're calling us, they perceive, hopefully rightly, that we're giving them value for that phone call. And so when we meet with these management teams who are considering selling, we go through our brand of private equity. And if they love it, all they're going to be concerned about is they get a fair value. They give us last look, as it is known, meaning they may get offers from 4 guys and we're one of them, and we may be the 4th guy. With YETI, when we were buying the business, we were the lowest offer out of 9 that they received, 9 or 10 that they received. And they came back to us and asked if we could structure something on the back end based upon performance. And it took me 5 minutes truly to negotiate the deal with the 2 brothers, because they wanted to work with Cortec. They knew they were going to be investing 35% of business, and they knew they needed our help to build it. And so we get those last look calls, investment banker, direct sale, doesn't matter. We wanted to be sure the business is for sale, and then we can figure out the rest.
And when you're increasing that evaluation from 550 to 900, how far do you read through each memorandum?
We don't read every memorandum. We don't.
Okay. For some things where you can just look at the numbers and say, okay, this won't make sense for us.
Yeah.
And you can toss it out. I'm looking at your team. It's not that.
It's much bigger than it used to be, but it's not big enough. No, if we did that. So there's a culling process. I'll tell you how it works. The vast majority of businesses that are sold through investment bankers, either they'll send you a 1-page teaser or you can have a phone call with them to vet the company. There will be some that are too big and some that are too small, even though they generally fit our criteria, that will call out of that group. That isn't even in the 550, 900. We don't include those in the businesses that we assess. That's how big the numbers really are. Then the next layer is, once we know it's within our size range and general, the bullet points over what they do. And you may find that margins are less than 30% at the gross line. Gross margins of less than 30% typically dictate a business is more of a commodity seller. Back to your early question, it's selling a commodity product or service. 25 in the line, you just see that. We won't buy businesses with gross margins of below 25% because they're not differentiated enough, and the market has told them that. by not paying them a premium for what they sell. So that's a really quick cut. That cuts out probably 25% of the companies that we look at. Others made inputs, commodity inputs. So we looked at a specialty food service ingredients company, 2 of them actually this week, and we killed them both based on what they did. Those conversations are a minute, and we review every deal, every one of those that has the right size characteristics, every one of those every Monday. So we've been going through for the last month, believe it or not. So 1 month, 250 deals. That's usually 6 months.
Yeah.
That's the number, 248 to be precise. And so some of those are taking 30 seconds. Some we go really deep, and we'll basically at our firm, believe it or not, our model is that when we, meaning a managing partner, will read every book that makes it past the first cut. So we're reading a stack of 10 books a weekend, as are my partners. And so the most senior people do the initial work, not the junior people. We don't ask them to do huge write-ups, none of that other. It's all just a big waste of time. You've got to have people who've got the experience to know whether or not it makes sense. And then when we see one that does, we share it with the whole firm. And we say, guys, gals, read this over the weekend, and let's be prepared to talk about it Monday. And we do. And we make a decision there. And then do we continue pursuing this? Do we kill it? Because it's more interesting, but it might not be interesting enough or make sense based on other attributes. Or 3 or 4 big questions come back. We'll go back to the banker, ask a few questions, and decide go, no go at that point. Such that, in a typical year, we really only go hard after 3 or 4 businesses. This year, it's going to be more like probably 10.
And you mentioned that earlier. That's because there's a tax change. So a lot of these founder-led businesses are trying to potentially take some of, or have some of their wealth
mitigate
preserved.
The risk of, capital gains are at 20% if they go up to 30, and we don't know where Biden and the legislature is going to end up. But also true coming out of COVID. It's interesting, Justin. I don't think you can bifurcate the two. We don't know for sure what causes people to sell, but COVID not only did performance wane for most businesses and then recover, it was a wake-up call that they were too concentrated, particularly entrepreneurs, too concentrated in an asset. They had all their money tied up in this one asset, and they saw it crash. And almost every business crashed for 3 to 6 months because a lot of them were shut down. So it's a terrifying wake-up call. I've had some conversations, and I'll ask these guys and women, are you bringing the company to market because of the tax law change? They're like, no. COVID scared the blankety blank out of me. So it's been interesting. So I think it's a number of reasons, but it's a big year. We still haven't bought anything intentionally. I've tried to get the COVID bump, as we call it, sometimes the COVID mountain, out of the system. So you can look at real apples to apples performance. And we look a lot at 2019, 2018 growth rates. We tried to pull 2020 out of it.
And one, I think, final question that's a little more specific to one company, but the home services industry with Groundworks.
Yep.
Now that I'm actually living in an apartment and not quite a homeowner, but originally I didn't understand the level of service available, that typically it's subpar.
You didn't have to, which is good. Don't buy a house till you have to.
Exactly. But I spent 4 hours yesterday bailing water out of our basement. So now I'm acutely aware of the problem. What have you learned about the home service industry? It seems like there's a lot more opportunity for what you're doing, not just in the basement waterproofing, but it seems like that whole category. What's the biggest challenge? What's the thing that you maybe weren't expecting that's hurt the most about that? This would be an area I'm quite drawn to. And one of my college classmates from Trinity, we talk a lot about going into that line of business. So what should we be looking out for?
First of all, you got to be careful of event-driven businesses versus, call it, daily issue fixing businesses. We had this weekend in the Northeast was an event. We had a tropical storm that was almost a hurricane, and it dropped a lot of rain, a lot of play. There are event-driven companies that pump 4 feet of water out of a basement for you. Groundworks doesn't do that. That's not what Groundworks is. So a business like ServPro or ServiceMaster, That's what they do. And I don't personally believe, as a private equity guy, that's a very good business to invest in, because your business ebbs and flows based upon the weather typically. And I've never believed that investing in the weather is a good idea, because the weather is changeable and it's absolutely unpredictable, even with an almanac and that. So Groundworks is different. Groundworks is focused specifically on fixing the things that cause basements to leak. So it goes to the root cause, which can be a number of different things, because water travels and water always finds a way to enter places if there's a bunch of it outside. And I've had to deal with this with my house. It is very complex. The key, though, is to build drainage systems that pull water away from the home. That's how you do it. So it doesn't happen within the home. It actually happens around the home. Number one. Number two, foundation repair is based on something related but different, which has to do with typically soil shifting, which happens all the time because it's actually a living thing, and the impact of those shifts on your home, which can, affect stairways and walkways, but it can also affect the balance of your home and what happens underground, which can again also cause water to enter your home. So it's really all related to water management. And that business has been a good business for a long time. But what made Groundworks interesting was that it was, except for one small part of the market, which is actually the Northeast, which was led by a company called Basement Systems, it was a local mom and pop business. And it was really, maybe there were a couple regional players, but it was really a fragmented industry that needed to be consolidated. And the founder of Groundworks, CEO, who started with one branch in Virginia Beach, Virginia, and basically believed that if you brought excellence, and it's actually a great lesson for you, Justin, listeners, which is if you bring excellence to a small business, you can extrapolate that across others. And he put money into a centralized training center and a whole bunch of other things, thinking about where he was going to go with this. So he invested early, which is really hard, as we talked about, into a head of training so that he could institutionalize processes, which make them much easier to roll out across large organizations. If you do things haphazardly and you don't have the ability to roll them out in a consistent fashion, you can't do 7 acquisitions a year and streamline and normalize all those businesses to a common set of practices. So he put that foundation in place, no pun intended, and he made the core business leverageable. Now we're almost at 600 million. Since he started it, was at 26. We invested, we were a little over 100. And we invested a year and a half ago. So we've grown almost 50-50 organic and through acquisitions. And the one thing I didn't count on that ended up being really nice wind in our back was COVID. And the reason why is because people are working from home. And the little cracked sidewalk or the little leak in your basement that you saw on the weekends once in a while and shook your head and said, I gotta fix that. You didn't, because it was a pain in the butt and maybe someone wasn't open on a weekend. And when you're there all the time, people said, I'm not putting up with this crap anymore. I'm going to fix my home the way I want it because I'm living in it. And it was a blessing. And we were growing at, I think, almost 20% a year without that, and grew 50+% last year organically. With that, we also got a bunch of acquisitions done too, because the Groundwork, being part of the Groundworks family, actually includes a very significant equity component that we push all the way down to the branches. So Matt, our CEO, believed in that. When he interviewed us as a potential partner for him, he said, what do you think about equity and how far would you push it down? And told him what we thought, which is that equity ownership is important to people who value it. And if your team values it at the branch level, then we should push it down to the leadership there. And he got out of his chair, came over, shook my hand, and said, you guys are my guys. Just, give me a fair value. And we actually broke right on value very, very easily because we thought the business model was extremely unusual. And we're the only player in the industry, which is very rare. When you're working in a consolidation investment strategy, usually there are 3 other PE funds who thought of it too. There's nobody. And the largest player now is probably 6 million in EBITDA at XYZ market, and we're 110 million. So you don't want to mess with us. You want to be part of the machine. And we pick the best players in every geography. pay them something fair and have them reinvest. So they own part of the bigger machine. And it's not, we're coming in to steamroll you. It's they pay a fair price up front, let you buy into the machine, and then we're all going to win in a couple of years together. That's what's working. So long answer. And I know you're running out of time, and I'm sure any one of your listeners is probably sleepy by now.
I really appreciate this. This was awesome for me personally. I hope it was great for the listeners too. I thank you so much for spending time. I learned a lot.
Well, I'm glad. Look, I'm glad. First of all, I appreciate it. It was very nice of you to reach out. And I hope a little bit of something helps somebody somewhere. And good luck, Justin, to what you're doing, and keep me posted. It's nice to meet you.
Great to meet you. Thank you so much.
Okay.
Have a great day.
Bye-bye. Yep. Thanks.